Most business owners think finance means spreadsheets, taxes, or talking to accountants once a year. In reality, finance is the skill of predicting your company's future before it happens. In this video, you will learn why your business finance strategy is failing and 3 proven steps on how to fix it. If your business finance strategy is failing, it is rarely because of low sales or weak marketing. Most failures come from deeper blind spots that business owners never measure. The surprising truth is that a business with rising revenue can still collapse because its financial engine is poorly built. The core reason is simple. Most businesses operate with financial hindsight instead of financial foresight. They react after damage is done. They optimize after cash dries up. They negotiate after invoices expire. The real damage happens weeks or months before the owner notices. Let's break this down so it becomes crystal clear. Most finance strategies fail because they measure the wrong things. For example, many owners track sales but ignore payment velocity. They track cost per unit but ignore cash conversion cycles. They track profit margin but ignore pricing power decay. They track expenses but ignore the cost of wasted motion inside operations. And because these invisible metrics are not measured, strategy becomes guesswork. Here are 5 surprising reasons why business finance strategies fail, even for good companies. Reason 1. Money timing is broken. Sales happen one month, payments arrive the next, salaries are paid every 2 weeks, taxes come quarterly, and unexpected repairs strike randomly. When the timing problem is not modeled, owners feel like money disappears. In reality, timing creates artificial poverty. If you do not model timing, you do not have a finance strategy. You have a cash guessing game. Reason 2. The business lacks internal financial signals. Every serious company has financial signals that speak before a crisis. Systems track how long inventory sits, how many days customers delay payments, how much pricing flexibility remains, or how often expenses produce returns. Most small businesses run with 0 financial sensors, so they cannot detect fire until the building is already burning. Reason 3. No cash conversion logic. Finance is not only about profit, it is about how fast the business converts effort into liquid cash. A business that sells $100,000 of goods might collect it in 90 days. Another business selling $50,000 might collect in 7 days. The second business is financially stronger, even with lower sales. Profit without speed is a liability. Reason 4. The strategy does not include psychological reality. Finance is built by humans, and humans make psychological mistakes. Owners discount prices due to fear of losing a client. Sales teams give long credit terms to close deals. Operations overorder inventory just in case. These behaviors silently break the finance engine. Reason 5. The strategy does not model friction. Friction is the invisible force that slows financial motion. Friction includes waiting for approvals, inefficient billing systems, manual paperwork, duplicated tasks, slow vendor communication, or late reconciliations. Friction adds hidden cost without appearing in accounting statements. If a business does not fight friction, its finance strategy collapses as it scales. Now, let's understand 3 practical steps to fix your business finance strategy. Step 1. Build a financial sensor network. A financial sensor network means setting up instruments that detect future problems before they explode. Here are the sensors every business must install. Sensor 1. Payment velocity. Measure how many days customers take to pay compared to how many days you pay suppliers. If customers pay in 60 days and suppliers want money in 30 days, you have negative velocity. Sensor 2. Inventory absorption rate. Measure how many days products sit before conversion. Slow rotation means cash is stuck in shelves instead of moving through the bank account. Sensor 3. Pricing power index. Track how much discounting is needed to close deals each quarter. If discounts rise over time, pricing power is dying. Dying pricing power is a silent killer. Sensor 4. Conversion of non-cash costs. Depreciation, amortization, and provisions are ignored by many owners, but they indicate how future replacement spending will squeeze cash. If machines wear out, that future money must be planned today. Sensor 5. Return on labor time. Track how many hours the team spends to produce 1 unit of financial result. High labor hours with low financial output signals long-term failure. Once these sensors exist, strategy flips from reactive to predictive. Step 2. Model financial timing before financial amounts. Most owners focus on how much money and ignore when money moves. Cash stress comes from timing, not totals. Let's understand how to model timing. First, map inflow events such as customer payments, loan disbursements, tax refunds, seasonal demand, or milestone billing. Then map outflow events such as payroll cycles, tax due dates, supplier invoices, rent cycles, loan installments, and maintenance schedules. After mapping, assign time windows to each category. For example, customers pay after 45 days. Suppliers must be paid within 20 days. Payroll cycles every 14 days. Rent hits monthly. Taxes quarterly. When you model timing, you uncover invisible pressure zones. If money comes in slower than it goes out, you must create timing adjustments. Those adjustments may include shifting customers to milestone billing, charging deposits before starting work, using supplier financing to match payment windows, converting fixed rent into revenue share agreements, leasing equipment instead of purchasing upfront. A business that masters timing becomes financially calm even without high profits. Step 3. Eliminate friction and increase conversion speed. Once sensors and timing models exist, the final step is to remove friction and accelerate conversion. Friction is the biggest financial tax that never shows up on statements. To remove friction, audit 4 zones. Zone 1. Billing friction. If it takes 7 steps to generate an invoice, payments will always be late. Simplify billing systems, automate reminders, eliminate paperwork, and provide multiple digital payment options. Zone 2. Operational friction. Measure how long tasks wait in queues, reduce approvals, document workflows, and eliminate duplicated roles. Time saved becomes cash gained. Zone 3. Communication friction. Delayed decisions, slow cash. Replace scattered chat tools with structured communication. Use weekly financial stand-ups so the finance narrative is always visible. Zone 4. Mental friction. If employees don't know how their work affects money, they cannot help the business grow. Teach financial literacy. Create dashboards that show cause and effect. People who understand money make better decisions. After removing friction, focus on conversion speed. Conversion speed means how fast effort becomes liquid cash. Improve conversion speed by reducing unused inventory, switching from credit to subscription billing, offering early payment incentives, breaking projects into micro milestones, using software for reconciliations. When conversion speed increases, cash flow becomes the engine instead of the outcome. If you found this video helpful, then like, share, and subscribe this channel to get more videos. Thank you for watching this video.